Well, good afternoon. Happy Friday, September 9th. Mark Milam here, your mortgage professional with Highland Mortgage. Let's get into what's happening in the world of interest rates and housing. So this week, a little bit of a mixed bag. We had a couple of bad days, a couple of days where we rebounded, basically finishing up the week where we started the week, which unfortunately is some of the worst levels we've seen so far in 2022, taking us all the way back. If you want to look for rate comparisons, it's going to take you all the way back to somewhere around 2008 in terms of relative interest rates in recent memory. That's not particularly great news for home buyers. The maybe one ray of silver lining here is that we haven't seen a huge sell-off continue. We've sort of held serve for the majority of the week, and really all eyes are on next week's CPI. That's a consumer price index. Next week's monthly CPI to tell us how we're doing on inflation. Is inflation getting worse? Has inflation already peaked? Are we down below estimates? If so, how far below estimates are we? As this leads up to September 20th and September 21st, where the Fed is going to meet. This is a regularly scheduled meeting, and they're going to announce any sort of rate change to the Fed funds rate. Now, futures traders are pricing in about an 86% chance that the Fed is going to bump the Fed funds rate by 0.75 of a percentage point. That would be the third time in 3 meetings that the Fed would have raised the Fed funds rate by 0.75%. Maybe this data next week will give us a little bit more insight, but odds are we're going to see the Fed bump the Fed funds rate late this month by 0.75%. So let's take a quick look at mortgage-backed securities just to give you an idea of what we've seen so far this week. And this is it. A lot of volatility. There's been a lot of trading up and down. It's been a wild ride since September the 2nd, but really finishing out basically where we started. Not a huge difference from where we began the week to where we're ending the week. The outlier here was September the 6th, particularly bad day that we experienced on December the 6th, but we've gotten most of that back throughout Wednesday, Thursday, and Friday. I did see, something posted on in the media about the jobs market and how really we're not in a recession because we still have such a strong labor market. I think there's a lot of noise in that number, candidly, especially when you look at the labor participation rate and realize that 38% of able-bodied, non-institutionalized Americans over the age of 16 are not actively looking for a job. So obviously unemployment is going to be a lot lower if you don't have to count the people who aren't even looking for work. But I actually saw a headline today, and this comes from an organization I belong to, the NBA, basically saying that a strong job market will continue to support housing demand. And this is a new article moving forward, and that did give me some pause, candidly, because I don't necessarily agree with that. I think that housing demand is going to fall off, and some of the most very recent data that we've seen has started to support that. And this all goes back to affordability. It's just become difficult to afford a house in a lot of markets. And I want to just show you an illustration of this, just to maybe have some numbers to digest. Let me move this out of the way. Let's assume that Joe Biden and Donald Trump want to buy a house. And let's say that they wanted to buy this house back in September of last year, 2021. So this month, but a year ago. And they want to buy a house that's worth $500,000 and they're going to put 20% down. Well, this time last year, the good old 30-year fix was where? 2.875%. They were 2 7/8 for this $500,000 home, and they would go off and buy it, and their principal and interest payment, we'll forget about taxes and insurance for now, their principal and interest payment would be $1,659 and some change, $1,659 and some change. Now, if we go over here to this appreciation tab, you can see over the past year here in Metro Atlanta, now this might get a little bit of play in it depending upon market, but on average, we've seen home price appreciation over the past year of 14%. So that $500,000 home that they would have bought this time last year is now at $570,000 so far here in 2022. And that P&I number of 1659 is going to go up. Let's go back here to option 2 here, or tab number 2. And let's assume now we're buying in September, not of 2021, but we're buying in September of 2022. And that home price is now $570 instead of $500. Interest rate, instead of being at, 2.875%, well, your interest rate now is at roughly 5.5%. So your principal and interest payment for that very same house 1 year later is $25.89. Let's go back over here to the appreciation tab and take a look. So in 1 year, the combination of the higher price and the higher rate has bumped your P&I payment from $1,659 and some change to $25.89 That's an increase, folks, of 56%. That's an increase of $929.55. And you might say, okay, all right, we get that. Home prices have gone up, interest rates have gone up. Yes, yes, yes. But so have wages. And this is what the MBA is pointing to. They're saying that wage growth is going to help keep housing demand in check. And it's going to help us keep good housing demand. Well, wage growth year over year is 5.2%. So let's say in 2021, to buy that home worth $500,000, you had an $80,000 salary, about $6,666 monthly. That's what you were taking home gross monthly. And you got that 5.2% wage growth, taking you all the way up to $84,160. Good for you, Joe. Good for you, Donald. You now make $84,160 a year. Your gross monthly income gone up by $346 a month to $7,013. Folks, a 5.2% increase in wage growth doesn't do a whole lot against a 56% increase in cost, right? There's no way that this can keep pace with this, and there's no way that we're going to see demand stay the same or demand be robust in light of what's happening to affordability. Now, one thing we do as a lender is that we calculate debt to income ratio to make sure that a given applicant can qualify for a given loan. And anything under about 45%, you should be good to go with a given debt to income ratio. And if we strip out all other debts, well, when you went to buy this house in 2021, your debt to income ratio was about 24.9%. In 2022, for the very same house, even with the wage increase, you're at about 37%. So still qualifying, of course, but a big difference between these two numbers in terms of disposable income. Let's move this out of the way and talk about one other thing here. Let me bring up one other screen for you just to kind of go through as we sort of refute this idea that a strong job market is going to continue to support housing demand. Here, Black Knight put out a report last month. This is a July report talking about what's happening with home prices. And you can see what's been going on with the 1 month home price changes. Of course, we know about the past 2 years, just crazy appreciation in home prices. But when we start talking about 1 month change in median price, now we're getting to sort of the leading edge of exactly what's happening with home prices nationwide. And take a look at what happened here between June and July. The August data is not in yet. Between June and July, we saw home price change from positive 0.18% month over month to negative 0.77%, a big miss in terms of what everyone thought was going to happen. In fact, July's price drop was the largest single month decline in home prices since January of 2011, 11 years ago, a little over 11 years ago. And it's the second largest July decline on record. All this to say, listen, wage growth is great. A healthy job market is great. Now, there's debate about whether we're in a healthy job market. I think it's a little bit of a dysfunctional job market when you have 62% of the population supporting everyone else. But that unemployment figure looks really, really good because we're not measuring a lot of people who aren't contributing. But when you talk about housing demand, of course housing demand is going to drop. When you've seen a 56% increase in the cost of owning the very same home against a 5.2 or 5.4% wage increase, and we're already starting to see signs of cooling demand and cooling house prices. And you know what? That's probably good. We probably do need to see a cool down for home prices so housing can become more affordable. This is a necessary step in order to right our housing market, which has been very imbalanced over the past 24 to 30 months. It's been a heavy seller's market and buyers have gotten squeezed. It's time for that to start unwinding itself, and that's exactly what's going to happen for the balance of 2022 into 2023. If I can be any service to you, please don't hesitate to reach out, mark.milam@highlandmtg.com. Have a good weekend.